Welcome to The Explainer. So today we're diving into the massive, sometimes crazy world of the foreign exchange market. We're going to see how literally anyone can build a rock-solid foundation right from the ground up. Let's figure out what it actually takes to become a Forex architect and master the essential tools you need to trade safely, specifically XNES and MetaTrader 5.
But hey, before we start building, we've got to face a pretty harsh reality. 80%. Yeah, 80%. That is the staggering percentage of newbies who lose their cash fast, usually within their very first 3 months of trading. It's a brutal statistic, for sure, but it's the absolute truth of what happens when you jump into this fast-paced world without a real plan.
So it begs the question, right? How do you actually become part of that 20%? How do these traders survive and, more importantly, actually profit? Well, today we are unpacking a structured blueprint to beat those odds. No fluff, no get-rich-quick nonsense here. Just the precise steps you need to start trading and profiting without completely blowing up your account.
All right, let's dive right into it. Here's our blueprint. Step 1, building your trading engine. Step 2, speaking the Forex language. Step 3, surviving the Forex market. Step 4, executing your first trade. And finally, Step 5, piggybacking off the pros.
Starting right off with Step 1, building your trading engine. Look, you can't build a house without a solid foundation. And you know what? Trading is exactly the same. It all relies on a really seamless 3-part flow. First up, you deposit your crypto, something like USDT or BTC, straight from your Binance wallet into your XNES broker account. XNES is basically the broker that handles your trades. Next, you connect XNES over to MetaTrader 5, or MT5 for short. This is the platform where you'll actually execute your orders. And finally, to really analyze the market clearly, you're going to use TradingView. So you analyze the charts on TradingView and you execute the trades on MT5. It is an incredibly powerful combo.
Moving on to Step 2, speaking the Forex language. To actually read this blueprint, we have to navigate some pretty dense market vocabulary. But don't let it intimidate you. First up, currency pairs. In Forex, you're always trading one currency against another. These 6 major pairs, like the euro against the US dollar or the US dollar against the Japanese yen, they hold 80% of the total market volume. Now, if you're a bit more crypto-savvy, you can also look at pairs like BTC/USD. The main thing here? Just start with a pair you actually understand.
Okay, next we have the pip, which stands for percentage in point. A pip is just a tiny price move. For traditional fiat pairs, it's usually the 4th decimal place, like 0.0001. But for BTC/USD, a $1 move is exactly 1 pip. Now, why does this even matter? Because pips are the crucial little units where your profits are actually made or lost. You don't track your success in broad dollars right out of the gate. You track it in pips.
Then we've got the lot. This is simply your trade size. While a standard lot is absolutely massive, we're talking 100,000 units of currency, it is super clear that beginners absolutely must stick to micro lots. That is an 0.01 lot size, representing just 1,000 units. Using microlots keeps your risk incredibly small and safe while you're still just learning the ropes. And finally, leverage. This is basically borrowed cash from your broker that lets you trade way bigger than your actual balance. For example, a 1-to-100 leverage means your $100 suddenly controls $10,000. It's like a massive power-up. But here's the catch, and it's a big one. While leverage powerfully boosts your wins, it magnifies your losses just as aggressively. It's the ultimate double-edged sword.
Which brings us to Step 3, surviving the Forex market.
Now, before putting a single real dollar on the line, we've got to look at the safety features. And what's really interesting here is the stark, undeniable contrast between account-killing rookie habits and smart, disciplined moves. Rookies, they trade with 0 stop loss. They use wild 1-to-500 leverage, and they love revenge trading, which is basically just angrily mashing the buy button after a loss in a desperate attempt to win it back. But smart traders, they set a strict 1-to-2% stop loss, stick to a very safe 1-to-10 leverage, and they walk away after 2 or 3 trades no matter if they won or lost.
There's a really famous saying in this space, no stop loss equals no money. A stop loss is this great tool that automatically sells your trade if it tanks, strictly capping your loss. And you need it because the market is violently volatile. Sudden news events, like say a recent post about tariffs, can cause an instant 27% drop in crypto pairs like BTC/USD. Without a stop loss during an event like that, your entire account is wiped out in seconds. You absolutely must set it every single trade. To survive out there, you also need the right radar to see what's coming. First, use Forex Factory's economic calendar.
It tracks news, so you avoid trading blindly into massive market-moving events, like interest rate decisions. Then, on your actual charts, rely on a few essential tools. Use moving averages to spot the overall trend. Check the RSI to see if the market is overbought or oversold. And finally, just map out basic support and resistance levels to find the smartest possible entry points.
All right, step 4. Executing your first trade.
Taking all of those safety measures we just talked about, let's walk through the exact mechanics of a practical application. First, you're going to open a free MT5 demo account with 10,000 virtual dollars. Next, set your leverage to a safe 1 to 10. Then, you enter a 0.01 micro lot buy order for BTC/USD at, let's say, $95,000. Immediately, you set your stop loss $500 below that at $94,500. This capture risk at exactly 50 cents. Then, you set your take profit at $96,000, aiming for a $1 win. See what we did there? You risk exactly 50 cents to safely target a $1 win. It is simple, it's mechanical, and it's totally unemotional.
The overarching reality of Forex is this: you have to grow slow. Consistent, tiny wins compound significantly over months and years. Seriously, earning $5 a day beats earning $0 forever. If you just remove the emotion and treat trading like a robot, a small account compounding by just 5 to 10% a month turns into serious capital over time.
And finally, step 5, piggybacking off the pros.
So what if you actually want to earn a profit while you're still taking the time to learn all those complex charts? Well, you can use expert signal providers. These are seasoned traders who literally tell you exactly when to buy, sell, and where to put your stop loss. There's a scannable menu of top-rated options out there. For example, FX Leaders offers free signals with around a 70% claimed win rate. If you want more volume down the road, services like Learn to Trade VIP or Wolfex VIP offer high accuracy for a fairly low monthly fee. But the golden rule here? Always test these signals on your free demo account before risking a single real penny.
Now, before we completely wrap up, we need to deliver a final reality check. You should aim for 5 to 10% monthly growth. Period. Forex is a slow growth marathon that requires absolute discipline. It is definitely not a get-rich-quick gamble. The pros take years to master this stuff, not days. So protect your capital first, and the profits will naturally follow.
So your blueprint is ready to go. Your XNS and MT5 engines are built. The challenge for you now is taking that very first step safely on a demo account. So, what will your first pair be? Thanks for hanging out with us on this explainer. Keep learning, stay disciplined, and happy trading.